So thank you everybody for joining. My name is Scott Cowan. I'm chairman of Ichigo. We're working off of the FY22 full year corporate presentation. So this is our full year earnings. I'm joined by Ted Fujita, who is our lead independent director, and also by Dan Morisaku, who's a senior member of finance team and the head of global IR for Ichigo. I'm going to hit start video again, and you cannot start your video because the host has stopped it. Continues to be the case, so we're just going to run forward. My apologies to everybody. You don't have to see my face. This may be this may be a feature, not a bug. So let's run forward. Turning to the first page, which would be page 8, and I'm jumping past, of course. They are it's a terrible time in the world. We've got COVID. We've got an extraordinary humanitarian disaster and war in the Ukraine. We stand with the Ukrainian people. Turning to Ichigo, rather than the world outside, here's what happened during the year. I mean, look, still a mixed bag. We expect a lot more from our business, and yet I think it's pretty clear at this point that a lot more is going well than poorly, and certainly on a forward-looking basis, we feel pretty confident that we've hit bottom and we'll go up from here. So some highlights from the year: flow earnings are up. We're up 6-7%. This is in the sustainable real estate business of both multi-asset and residential sales. So the key change there is last year we were primarily selling Ichigo owners assets, which are residential assets. There's clearly been a broadening of the market and its appetite for a broad range of assets. So our sustainable real estate business is coming back. Even in the most damaged asset class, and we've taken a bunch of damage from COVID in the hotel space. We actually did a hotel asset sale at a very good price in the final quarter. So hotels continue to be fairly specific with respect to location and buyer, but things are coming back. Second point, Ichigo Owners was a business we started 5 years ago, continues to grow very, very well. Acquisitions were up 10% year on year, and that, this is a super prime Tokyo residential business. There's just voracious demand for these assets. When acquisitions are up, that tells you that earnings will be up. So it's a very strong leading indicator of returns. Going to be, we launched a new business, a co-ownership business, to continue to drive our long-term stock earnings. By stock, of course, we mean we're a stock plus flow business. Flow is kind of what happens on a daily basis, and you can have very durable flow, but it's not kind of embedded or structural earnings. Stock are things that are embedded in contracts, such as rental agreements and that sort of thing. So the co-ownership business, we think, will be an earnings driver. And again, to remind you what that is, it's small lot, the ability to own kind of a single, parts of real estate at $10,000, for example, at a time, as opposed to kind of buying a $10 million building by yourself. So that is a brand new business we launched last year, and one that we think will be valuable. Looks like we may have video. And we have video. Now you have to look at me. Again, I don't know if that was that's a feature or a bug. So turning to, and then clean energy business, stock earnings were up 13% year on year. This is a great business. I mean, it's a stable earnings driver, and it has extraordinary deep social significance given what's going on with both global warming and the problems we have with trying to get enough energy to keep ourselves going in the midst of the Ukrainian crisis. 9 new plants online last year, including our first wind power plant. And this is a business we need to and will grow. Propera is our proprietary AI-based hotel revenue management system. It's growing market share. We went 2.6x the number of hotels that are on this system. That's obviously small. You'll see later on in the presentation, we expect to grow that very, very substantially this year. So this is on a growth track. You should watch this very carefully. Our ability to grow this business, given the powerful kind of platform economics to it, is a potential significant driver of our corporate value. We did a 1.5 billion yen share buyback. Dollar has gone from 103 yen 2 years ago to 128 today. So it's not as easy to say at 100 yen for a dollar, $50 million, because it's become slightly more complicated math. But anyway, about $12 million, and we announced another share buyback of the same size today. It is the 6th consecutive year of us doing buybacks. I'll talk a little bit more about our approach to buybacks later in the presentation. Next page, please. So this is what it looks like in terms of our stock earnings versus fixed expenses. It is incredibly important to us that we be structurally profitable. So it's a way of saying the flow earnings are powerful and they're ongoing. But in the worst case, even if we have no flow earnings, we expect to be robustly profitable. And as you can see, our stock earnings are about 2x our expenses, so we don't expect to ever go upside down, and that's really, really important. Turning to the right side of the page, our stock earnings, a drop off, very unusual, given how durable our sustainable real estate earnings are. This is mostly rental income. This has just been absolutely unprecedented, but a drop off of 10%, largely offset by an increase in stock earnings in asset management and in clean energy. Next page, please. So one of the things we've done from today is to try to give you more, and I apologize if I didn't express my thanks at the beginning of this call for everybody for joining. We're incredibly grateful for your time. It's important to understand the firm's economics. And by the way, this is not meant to make us look good. This is meant to be something about Ichigo, but we're actually pretty pure. So we think we need to be transparent. We think we need to exist for the benefit of the world. And one of the issues that's occurred with transparency is, as you know, we have moved the majority of our assets into the fixed asset class, which is not only just an accounting category, but is actually a tax category. And by moving our assets from real estate for sale to fixed assets, it enables us to have the tax shield of depreciation, which is really, really valuable. So with a 30% tax rate, we've got about 5 billion yen of depreciation on an annual basis. That translates into 1.5 billion yen of increased cash available to shareholders. It doesn't show up as profits. And so that's one of the things we need the market to understand, is that we're actively managing the firm to maximize cash flow for long-term cash flow for shareholders, but it means we're going to be hitting net income and EPS, and we need to be transparent about that. And so we introduce cash-based accounting that it'll be on the next page that I'll go through. But one of the things that also needs to happen is by moving assets into the fixed asset category under JGAAP, so under Japan's accounting system, it means that the sustainable real estate activity, where we add value to assets and then we sell them and make money because we've added value to assets. If you're doing that against real estate for sale, it shows up as OP, as operating profit. But if you do it against fixed assets, it doesn't show up as operating profit. It shows up as extraordinary gains. So the result of this is, because we think we've done the absolute right thing for all of you, our shareholders, which is to maximize cash flow, we now have a P&L statement that looks like we have kind of a certain amount of OP, operating profit, and then like a whole bunch of extraordinary gains. And it's like, what's going on with these guys? And that's purely a function of us using the tax shield. And so in order to truly understand what's happening with the sustainable real estate business and the profitability generated of it, you need to put back those extraordinary gains into the operating profit number, because it is truly operating profit. This is core activity of the firm in sustainable real estate, but it's sitting in under Japanese GAAP extraordinary gains. So let's turn to the next page. We can see the actual numbers. And so as you can see, all in OP, so that's what we're calling it, all in. You take not just operating profit, but you return the numbers from down below in net income back to the operating profit line and the recurring profit line. So all in OP was up 28% year on year. Cash EPS was up 33%. And again, these are, we think, the most important numbers that you should look at. You should understand how we're doing on an OP basis, and fully understand that, including kind of unraveling the accounting kind of treatment that makes that harder to see. So we try to do that by giving you all in disclosure. And you should also look to see how much cash we're generating. And so these are numbers that year on year have done very, very well, and we expect to continue to do well on them and continue to grow them. And you should be tracking us on this. So that's what the year looks like in terms of the numbers, and let's run forward. Next page, please. So breaking this into categories, the other thing that we've done from today, again, we think, we think the stock is underpriced. That's why we're in the market buying the stock today. We think part of the reason for that may be that we need to be kind of more transparent and help understand the economic drivers of profitability. So we've tried to do better disclosure on that. So one of the breakouts that you see from today, so if you look at all-in operating profit, you can see asset management is up 31% year on year. We've now broken out between our two categories, subcategories within sustainable real estate from today. So we have the multi-asset business, which is our classic long-term across all sorts of assets, value-add business, typical hold of 3 or 4 years, and again across all asset classes, what we think we can add value. Primarily, this is we're operating in hotels, office, a little bit of residential that's migrated primarily to the owner's business and retail, and then the owner's business, which is a short-term hold, typically 7 to 8 months. Much quicker turnover, primarily Tokyo super prime located brand new residential. So these are very different business models, and we thought it important for you to understand those different business models. And you can see, they move around a certain amount. These are businesses that are primarily, the owner's business is almost entirely flow earnings because it holds, stock earnings on real estate is typically rental income. And since you've got a 7-month hold, you're not holding this for very long. You turn it over. But as you can see, the multi-asset business doubled year on year, and owners nearly halved. And that's fine. We don't pressure these businesses to make sales based on kind of fiscal year or anything like that. They move around and they generate the earnings that are durable and they can move between quarters and move between fiscal years. The implication to that, of course, one, that multi-asset to come back is really important to us, and to owners will just have more earnings next year and the following year. And as you can see, also clean energy was up 16%, and this is just a robust, really good business that is indifferent to the operating environment. Next page, please. I won't go into too much detail on the COVID impacts. You can see on the bottom, we have in bold font, office and hotel, highlighted in Q2 and Q3 because of the changes that have occurred there. Primarily residential and clean energy, they have no real impacts. The one area that is having a significant impact continues to be on stock earnings is hotels, and it continues to be kind of relatively impact, but more than relatively impact, it's fairly significant impact on the buy-sell element, which is flow earnings in the bottom. Next page, please. So just to go through kind of the elements of our business model, and again, this is something we talk about regularly because we think it's important to understand, but I'm not going to spend tons of time on it because it's something we talk about regularly. So, at the heart of the business is a combination of both kind of robust stock earnings, which make us structurally profitable, and on top of that, we have flow earnings. You can see the big drop off that occurs as we moved into COVID, both on the stock side because of this. These are very, very durable earnings, except the hotels went from making lots and lots of money to making no money. And these are kind of contracted rents that we think kind of very durable. We think they should be described as stock earnings because they're very, very durable. But when we had a global pandemic, things went really south there. And then also a fairly significant drop off in flow earnings. I'll talk to that later. You'll see that flow earnings are going to go up quite a bit and more, and we still got pressure on stock. Next page, please. And this is how things break down. You can see you've got asset management on the top, you've got clean energy on the bottom, sustainable real estate in the middle. Sustainable real estate has been overwhelmingly our biggest earnings driver across the board, and also for stock earnings. It has gotten squeezed very hard by COVID. We've got growth in clean energy, and asset management has been relatively stable. Next page, please. The other element that's important is that we have embedded forward earnings. We add value to our assets day in and day out, but on an accounting basis, those earnings, that value creation is not doesn't come into existence until we actually do an asset sale. And so we have annual third-party appraisals of all of our assets. The appraisers think that we've got 6.5 billion yen, 65 billion yen of unrealized gains on our balance sheet, which tells you that they think NAV is about 65% above what our balance sheet is. And if you turn to the next page, in fact, those accounting-based, third-party appraisal-based unrealized gains are very, very low. In fact, we have typically 2 to 3 times that with a really, really good year in fiscal year 18-2. But you should expect 2 to 3x our appraisal-based, third-party appraisal-based unrealized gains. And so the implication of that is that we've got something like 2 to 3x our current stated BPS and actual NAV. Next page, please. The other thing we focus on is robust cash generation. Earnings are about accounting earnings don't necessarily come with cash, and so that's how you can have accounting earnings and not actual real cash flow. So we're very, very focused on generating significant cash flow. You can see the big COVID drop off that occurs. Nonetheless, we'll robustly generate much more cash than what our stated net income is. Next page, please. And then finally, we one of the great things about being in Japan is that you can borrow kind of for forever, kind of fixed at almost nothing. So we continue to borrow at average term of 10 years at less than 100 basis points. That's fixed. We've had some drop off in the remaining loan maturity. That's because a lot of our businesses now is 7-month business, and we've been fine with that. But we will stabilize that number. But the thing that's important to understand is we have very, very durable, not just equity capital, but durable debt, which enables us to sustain the business very well and kind of ride in and out of difficult periods. Next page, please. Let me turn to sustainability. One thing that's worth pointing out is we are robustly climate positive. So we have, based on our solar and wind power plants, about 2.3 times more CO2 reduction than our total CO2 emissions, and we think that's an incredibly important social contribution, and that we'll continue to focus on. On the next page shows something totally different, which is not, the previous page on the left-hand side showed kind of everything we're doing for reduction. The right-hand side showed emissions. This page shows how much we're doing on to reduce emissions. So we have a target of being 100% renewable energy, and that's for electricity by 2025. And 80% right now of our total energy consumption is electricity. The other 20% is gas. So we're 53% of the way there. And that generates a total reduction of 43%, because again, it's against the 50% target, and we fully expect to get 100% renewable energy under the RE100 electricity standard by 2025. Next page, please. It's pretty clear that ESG has got a very, is extremely important and to the world, and increasingly important to investors and to financial institutions. And it's also pretty clear that Ichigo is well advanced in this space, and so we are increasingly recognized for our for kind of our robust environmental credentials. For example, we're getting financing. This will be an example of financing we got from Shinsei Bank just 2 months ago. Next page, please. And broadly, because there has been a shift towards greater understanding what needs to happen to support the planet and avoid us tipping over from global warming, there's an increasing market for providing ESG lending. These terms tend to be very, very attractive. They, for example, will frequently not have amortization in them, not really any covenants. This is very good debt. So, we are very interested and very focused on having as many ESG loans as possible. It's currently 70% of our portfolio. We expect to grow this from here. Next page, please. As you can see, we are increasingly in ESG indices. We'd like to be in more. We are, in fact, in 3 of the 5 indices adopted by GPIF, the Japanese National Pension System, which is the largest pension fund in the world. We are leadership. We awarded leadership and a score of A- from CDP. We continue to get lots of acknowledgement for the truth, which is we're very, very focused on having a light, stepping lightly on the planet and trying to do everything we can to be responsible. Next page, please. So turning to what's happening in terms of the three different categories, sustainable real estate, we continue to be selective on acquisitions and sales. We've been saying this for years. That particular title hasn't changed because we are selective in acquisitions and sales. I pointed out earlier, residential sales continue to be relatively stable. Market conditions are also allowing for us to be active across kind of all asset classes, which is very, very important. You can see that we continue to be primarily acquirer in Ichigo Owners, so that's in super prime residential. We would like to do more in other asset classes, and we will, but in the last year, we were primarily focused in the resi area. And then sales, actually primarily in multi-asset outside of Ichigo Owners. So you can see on the bottom of the page, multi-asset was a net seller of about 22 billion yen, and Owners was a net buyer of about 8.5. Next page, please. Owners is going very well. You can see, so this is the 1, 2, 3, 4, 5 years since we started the business, and it will continue to grow and continue to grow our profitability. Very nice business. When you think about it, the ability to turn over kind of assets at 7 months, at kind of a 10 to 15% gross margin using leverage. I mean, this is like, I have to actually do the math. Something like a 40, 50, 60% ROE business. Somebody's a really, really good business. And because it's very high turnover and you have really, really good assets, the amount of financial risk you're taking on it is very low. So it's a great business and one that, we're happy we created. I would point out, we think it is also, very responsible. 10 to 15% gross margin is actually much lower than what the market has been asking from buyers. So we are the value leader in this space. We thought the margins were way too big. We thought we could do better for our customers and for our investors by providing better value, and we are. And so this is a business with extraordinary robust demand. Increasingly, we're recognized as in a sense, the premier provider of high class residential in Tokyo, and so we will grow this business. Next page, please. Asset management. We've got 3 different listed vehicles: 2 REITs and a solar power producer, green infrastructure fund. These haven't grown very much over the last couple of years. It is a priority of the firm for us to do more here. And you should track us on that to see if we have. It's worth pointing out on the ESG topic that Ichigo Office has cut over 100% to renewable energy. It is the only REIT, only Japanese REIT that has done so. So we're leading the pack there. At this point, Ichigo Hotel is 31% cut over renewable energy. Ichigo Green is a renewable power producer, so it is by definition 100% renewable energy. So we didn't put that on the page, but that's true. Next page, please. Here's what's happening on the clean energy business. It has grown very rapidly. It slows down this year a bit. We've talked about this before. We don't have a slide in this presentation. We'd like to go into green biomass and hopefully start that business this year. So, that is work underway, and hopefully we'll have some good news for you when we start the business. When I say green biomass, I mean actual biomass that's good for the planet, because really a lot of the biomass out there is not. If you want to have a conversation about that, we can. But this will be generally good for the good for the planet, locally sourced, full cycle, good for the planet biomass. Next page, please. I touched on Propera earlier on the first slide. We 2.6x it this year. We expect to 4x it this coming year, so in the next 12 months. So that's obviously a very important growth target, and this could be kind of a very valuable platform. The basic kind of the customer use case for this is Japan does not have very sophisticated pricing optimization for its hotels. There's a large market opportunity for this. We have spent years developing a proprietary AI-based system for this. When we put this into hotels, typically the uplift is 20% or more on actual revenues. So it's a even higher translation to NOI growth. And so this is something we think has significant kind of customer and social value, and we expect to grow rapidly. And stay tuned. Next page, please. So we've done our 6th consecutive year of buybacks, and we will, as of today's announcement. Let me just touch on this one a little bit. So as you can see, we've generally done 3 billion yen of buybacks kind of year in, year out, twice a year. Last year, we only did 1.5 billion. And so we got all sorts of questions as to why we weren't doing more buybacks when the stock was cheap. And the answer is we are very involved in trying to do more and to try to do things that are big. And that results in us having, on a not infrequent basis, material non-public information. And if we're sitting on material non-public information, we can't buy back our stock. And so, anything, for example, that's going to generate over 10% of forecast sales, so a very large, for example, owner's transaction, or a very profitable owner's transaction, anything that will generate over 30% of forecast net income falls into the material non-public information bucket. Anything that you would think normally is material falls into the material non-public information bucket. And so, and the challenge is, so if we're sitting on MMPI, and we'll get a question, and I'll get a question. They'll call, why are you buying back your stock? And I basically have to talk in my sleeve, because I can't say we're sitting on MMPI, because that would be releasing MMPI. We wouldn't know what it is. And so you end up with this kind of mumble thing. So the reason I'm telling you this right now is for all of you, next time you think the stock is cheap and you think, hopefully correctly, that we're very aligned with our shareholders and we're going to be buying our stock when it's cheap. The answer may not be, oh, Ichigo 1 doesn't think our stock is cheap, or Ichigo 2 doesn't have a financial capability to buy back stock. We think our stock is very cheap, and we have robust ongoing capability to buy back our stock. The answer may be, oh, they're sitting at MMPI. But if you ask me that question, or if you ask Hasegawa-san, our CEO, in Japanese that question, we're going to mumble into our sleeve because we can't actually talk about it. So just FYI. Hopefully I've given you the information you need to know to understand why we only did 1.5 billion yen last year. And so next page, please. We continue to have a J-League shareholder program. It's 2 firsts for a shareholder program in Japan. We include not only our own shareholders, but also shareholders of our REITs and Ichigo Green, a listed solar power producer. And we're also the first company to offer shareholders tickets to every J-League game. This, of course, had a COVID impact that was really unfortunate. J-League is back up and running, so we're back giving out tickets to our shareholders. Next page, please. Let me turn to the forecast. So again, the two we think most important numbers here are all-in operating profit and cash EPS. And as you can see, I mean, and if you look at FY22 on the left-hand part of the page, I didn't touch on this on the results page. We literally are generating cash EPS that's twice our stated accounting EPS. So we are far more profitable than what your classic EPS numbers look like. Which is another reason why we have every ability to invest for the future, including buying back our stock. We think it's cheap. And so turning to the right-hand side, you can see on all-in operating profit, we think, we've got a range. It's still super uncertain out there. There's COVID uncertainty, of course, but there's also kind of macro uncertainty. There's Ukraine uncertainty. So we thought, we actually talked about, should we go with the spot number? Should we get rid of this range thing? We don't like the range thing. We like to have numbers we put out and we beat them. But the challenge with that is, it would call on us possibly kind of be conservative given all the things that are going out there, because our job is to beat our forecasts. And so we decided to go with a range yet again this year. As you can see on operating profit, it's biased to the upside, -4 to +18. On cash EPS, -3 to +13. The actual EPS numbers will look better than that. They'll be +2 to +33, and that's, of course, we did some impairments last year that pushed down EPS. That didn't have impact. They were non-cash impairments that didn't impact cash EPS. I mean, as Ichigo, and we have Ted on the call, who is both our lead independent director and also the head of our audit committee. We're very conservative, and so every time we have an opportunity to go, this looks like it could have impairment risk, we write stuff down. Historically, the result of that has been we write it down, we actually get the money back, but we are very conservative about uncertainty. Next page, please. In terms of segment details, we've got asset management down 40. Sustainable real estate is up 1 to plus 32. Multi-asset is going to be down from down 10 to plus 30. Owners is going to have a rebound, plus 39. Clean energy, plus 3. Just to turn to the asset management number, it's probably wrong. One of the things that we've looked, it's in part, it's a function of about 20. Half of that is a drop off of we have performance fees on office sales. We have performance fees in both our office REIT and hotel REIT. We are actually the only J-REITs that are entirely based on performance fees. We think that creates alignment with our shareholders, and no one else wants to take that risk. So we are very aligned with our shareholders across kind of everything we do. And so that drop off is we didn't put the performance. We don't have an assumption about kind of a gains on sale that would accrue performance fees for us in the office REIT. So that explains about half the year-on-year drop off, and the other half actually is kind of internal allocation, which we kind of look at and we're like, this doesn't make sense. So to be clear, we kind of shifted up our allocation regime for how we allocate headquarter costs. So the asset management business is a really low cost business. It uses no equity. It's a phenomenal business. It's arguably our best business because it's a non-asset business that uses no equity. It has really durable returns to it. But because it's low cost, and we shifted up our allocation mechanism for how we allocate headquarter costs to the various segments, we noticed it's like, we're sending a bunch of costs to asset management. This doesn't make sense. And quite honestly, realized it didn't make sense and wanted to change the allocation regime. I didn't have enough time to talk with our external auditors about this. So we expect to fix this by Q1. You should know that there's not really that kind of significant drop-off in the asset management business, and apologies, we weren't able to fix these numbers. By now, we will be totally transparent about what we do, and go through kind of a robust process with our external auditors to walk through kind of what went wrong with allocation mechanism, why we need to fix it, and we expect to get it done by Q1. Next page, please. And this is the final page before it's because I won't go into the appendix. You can see on the right-hand side a mix of kind of course, stock and flow earnings. Note the big drop-off in stock earnings. We continue to have kind of pretty severe COVID effects. And if you look compared to 2020/2, so the February 2020, there's a 5 billion drop off in stock earnings, which is mostly about hotels. A certain amount of Odaiba, or one big office asset in it. So, which is just extraordinary. We have never experienced anything like it. We're still experiencing these stock earnings effects. We don't think we're going to get a return on. We're not going to get an improvement this year in Odaiba because we're going to give 6 months free rent to lease up the space, and I'm happy to talk about more what we're doing to reposition the asset. So a drop off in stock earnings occurs this year. It comes back from next year. But as you can see, there is actually a fairly substantial rebound in flow earnings, which speaks to kind of the overmarket has come back. So we experienced two very significant COVID impacts. One is this drop off in stock earnings, which we're still experiencing. We expect it's remedied from next year. The second one was kind of this kind of collapse in liquidity in the broad real estate market for our sustainable real estate assets, and that is largely cleared at this point. So it is coming back. Those are my prepared remarks, as it were. Thank you, Greg.
Yes. Two questions, please, Scott. Sure. One is, you alluded at the beginning of the call regarding an improvement in the situation for hotel transactions.
Yeah.
I was wondering if you could elaborate on that. And then number two, as far as shareholder return are concerned, I see that management has decided to leave the dividend flat despite the improvement in cash earnings.
Yeah.
I was wondering what are the the thoughts behind that, because one more yen would have been perhaps nice. Thank you.
Yeah. Okay. So on hotels, look, we did an asset sale in Q4. It was at a robust and good price. It was a global investor taking a view on, COVID is coming to an end, and investing on the rebound. That was very, very promising. And it tells you that, that was a market that was kind of, it was very frozen. It's began to open up. So we actually have a number of hotel assets that we're happy to sell. And so we kind of put them in the market, and we expect we'll see some transaction activity around that. But what's important about that transaction was it was above kind of pre-COVID pricing. So that was great. That's what's happening there. Broadly speaking, two things are happening that are going to be very robust and contributory across kind of all assets, not just hotels, to profitability. One is we're experiencing inflation again, labor inflation, materials inflation. And so what it tells you is replacement cost has gone up. So existing assets become more valuable relative to building brand new assets. And so we own a whole bunch of existing assets, they become more valuable. And two, the yen is weakened. And so, Japanese real estate is on sale. I mean, just in a very profound way. And this is a very robustly reforming asset class that has done well for global investors for decades. And so we're seeing kind of a significant uptick in demand from global buyers who are interested in buying assets at 128 yen when it would have been 115 yen at the beginning of this year and 103 yen at the beginning of last year. Greg, is that all right? Did I get to your questions?
Yes, thank you.
Okay, thank you. Let's turn to Will. Oh, I'm sorry, wait a minute. I need to talk about the dividend.
Yeah, the number 2, yes.
Oh, look, I mean, I thought hard about the dividend. We think the stock's very cheap. So we leaned into, and so, as you know, we expect to have ongoing activity in buying back our shares. And two, we actually talked about the dividend today at the board meeting. Have a DOE policy, which is, we think pretty clear, which is we expect to return, it's a DOE based dividend on equity. So above 3% of equity we'll pay out year after year to our shareholders. It's got a floor on it. So it's progressive. So that dividend is effectively a guaranteed return on our BPS for all of our shareholders. We can bump it to 8 yen, and it's like, well, why would we be doing that? Well, it's because we can, would be one answer. But it's a worthy question and a worthy debate. We did think about should we move the dividend to 8? Should we keep it at 7? We decided to keep it at 7 based on a dividend policy and do a buyback and possibly more buybacks. I hope that makes sense.
Okay, thank you.
Thank you. Will, you're next up. Can we unmute you? And can you unmute yourself?
Okay, hi.
Hi, Will. Thanks for joining.
Yeah, thank you, Scott. You answered some of my questions, so thanks for that. The next question would be on the Odaiba transaction specifically. I believe I heard on the Japanese call that it was about 80% utilized now, or 80% occupancy, and you had to give up 6 months free rent. Can you just comment on what level, versus the prior tenant? Did you have to, cut the new rent by X percent? Roughly speaking, how far down is that? And, once it becomes fully rented, let's say by the end of this year or next year, what's the full upside from that asset getting back to, closer to full utilization? That's the first question.
Okay.
Then the second question, in the stock earnings, you explained a little bit might be from this asset management business accounting allocations, but definitely from Odaiba impact. But then I think there's a comment that other COVID factors. So is this specifically retail or additional rent decreases from hotels? Just a bit more specifically on the non-Odaiba related stock earnings and what's behind those assumptions. Thank you.
So let's see. Let's start with Odaiba. So actually, what's going on with Odaiba is it's currently 50% leased, and we expect to get it to 80 by the end of this year. And we will be giving kind of 6 months free rent on that, and that's generally kind of on. That's on like typically it would be like a 3-year lease. And you know the thoughts about kind of free rent is used all over the world. It's also used in Japan. It's used here in part because moving costs are really, really expensive. And so it's helpful for tenants to be able to absorb some of those moving costs effectively by having a free rent period. So generally in Japan, classically, you will have anywhere between 2 to 3 months free rent to like 9 months to a year when things are really, really bad. And so 6 months is kind of right in the middle of the ballpark. For us, the advantage of free rent is it's attractive for the tenant. It also means you've got a higher. You know, we understand you don't get cash flows for the first 6 months, but then again, you know, we then tend to have an earnings stream that lasts typically for 5 or 6 years. That's substantially higher. And when the next tenant comes, they want to know what the existing rent is, in place rent is. It's higher. So you know, because we are so robustly cash generative, it's kind of we're perfectly happy to finance our tenants in a sense for the first 6 months. So look, the downdraft on Odaiba this year, just from last year. So looking at this drop from 114.9 billion yen FY22 to 13.1, 10 of that is Odaiba dropping off. So you would expect at least kind of 10 or more. I'm sorry, when I say 10, I meant 10 oku. Sorry, oku being a Japanese word, guys, which Will knows. So let me stay on billions of yen. So 1 billion yen of that is going to be Odaiba. And I think, and I don't have it in front of me, but I think the Odaiba drop off has been you know, occurred in previous years also. So it's probably 1.5 or it's probably 1.5 or more. And that will come back. And so in terms of the actual levels, they're kind of bang on where they've been. So kind of something that looks like 15 to 16,000 yen per tsubo. So and the actual business plan for this asset was underwritten at something that looks like more like 13. So it continues to actually outperform the business plan, which tells you, one, it's a great asset. I mean, it's a big asset, which has been disastrous under COVID because it's the only big asset we own. Small mid-sized office has been extraordinarily robust. No real increase in vacancies. And when you release, you're actually releasing at a step up. So typically 10 to 20% higher rents. And so Odaiba is very, very different from that. It's not this like robustly, wow, this is going fantastic, no vacancy, and we get to release when there were long vacancy. When tenants leave, we get to make more money. Odaiba is not that. It's a large office. Large offices have been struggling in Tokyo, but it's a good asset at a really good price for tenants. Meaning, it's a headquarters quality building. You know, at 15 to 16,000 yen per tsubo, when competitors, you know, in central Tokyo, so this 20 minutes out, would be something that looked kind of 2x that. Did that answer your question, Will? On Odaiba, I know I'm going to turn to stock earnings too.
Yes. So I guess the 80% is already decided.
No,
is that
no.
That's the target.
That's the target.
Okay.
Yeah. Well, we think we'll get there.
And on the hotel rents and retail rents, so the non-office impact to stock, how's that going?
So there's a drop off of about 1.9 billion in stock earnings between FY22 and this year's forecast, right? So 1 billion of that was Odaiba. About 400 million of that is a drop off of us actually doing a very advantageous COVID lease to the government for a COVID facility at one of our hotels, and another 500 million of that is asset sales and expected asset sales, and we haven't actually priced in the possibility we're going to get rent from asset purchases. So that's what explains the 1.9 billion. And the asset sales would be, it's a mix of both office and retail. The 500 million drop off. That's the difference, the 1.9 billion yen between last year and this year in stock. So the implication of that is we'll get Odaiba back. And look, I mean, the 400 million yen on the COVID thing is a water in the bucket relative to the disaster that's been the loss of stock earnings, which is kind of between 2022 and 23, this year's forecast, 23.2, a 5 billion yen drop off in stock. Most of that is hotels. So you know, at some point COVID comes to an end and we'll get that back. But that's what kind of the immediate future looks like.
Thanks very much.
Thank you. Next, we'll take Penn. If we can unmute you and you can unmute yourself. Penn, you there?
I think so. Can you hear me?
Yeah, you're definitely there. Thank you very much.
Excellent. Thank you so much for making the time as always.
Sure.
So I just have a couple of very basic and potentially silly questions, but
No.
I mean, you mentioned the yen weakness, which is
Yeah.
rapidly accelerating as we speak.
Yeah.
What is the key delta here in terms of what's changing from a macro environment in terms of global interest? Because I guess from everyone keeps on saying, yeah, Japan real estate is on sale, but
Yeah.
if the asset base and the cost base and the interest base is, if everything is yen based, yeah, maybe it's just my misunderstanding, just trying to understand what a weaker yen actually changes, and maybe if you could expand upon that in terms of maybe interest rate differential, stability of Japan, et cetera, where the foreign interest is really probably coming from.
Yeah.
And then second question, very separate again, on the buyback. So you mentioned the MNPI side of this.
Yeah.
So why not just announce a much larger buyback, and with a longer dated range, and give yourself more flexibility? And again, something that I don't understand. You've explained in the past how you have to do all this through sort of a trust bank, and you have to leave a lot of things in their hands. But yeah, maybe if you could explain why you couldn't just make something much larger and then maybe put a top end limit on where you would actually buy back the shares at. Thank you.
Okay, so thanks, Ben. So the question on JPI weakness, you know, global investors always worry about, are they going to get returns that turn into returns in their home currency? So you both get the local currency return, and then you have to worry about FX. Is the target currency going to appreciate, depreciate? And so effectively what's going on is there's an implied view that FX, a lot of FX risk has, you know, that the risk has gone down, or perhaps an implied view that the yen is at 128 yen. It's literally at on a effective exchange basis at a 50-year low. That a half-century low for the Japanese yen is a reasonable entry point. So you're absolutely right. It is the case. I mean, there's a little bit perhaps of, you know, we want to spend $200 million, and we can and that's our budget, and now we can do bigger assets. We want bigger assets, but it's overwhelmingly people think 128 yen or 123 yen or 120 yen is a very attractive entry point from an FX perspective. So, you know, you're absolutely right. It's all the economics are yen-based economics. It's the ability to not lose on the yen and perhaps gain on the yen, which is proving to be attractive to people. So on your first question, does that make sense?
Yep. I just find it a bit surprising that people are, yeah. Wouldn't global investors actually hedge out the yen exposure? That's sort of how I would have thought of it.
Yeah.
They actually wouldn't want to take that currency bet. That's not what their expertise is.
Yeah, and some people do, but most don't, because, you know, long term the issue is that and so kind of in defense of some people do, but some people don't. I mean, you have to roll the stuff, and so there's a little bit of operational issue around that. You're certainly not going to be able to really do very well kind of 5-year or 10-year FX trades. So it's interesting. You know, a lot of global investors do see FX. So FX exposure is diversification correctly. It is. And so that's another reason why people don't hedge out the FX exposure. The yen, the yen dollar cross is super liquid. You can hedge it out, but you generally can hedge it out for 3 months, 6 months, and then you start rolling, right? So it's interesting. From my experience, overwhelmingly, global investors in Japanese real estate do it in the yen, and so they care where the yen is.
Thank you very much. Sorry for the basic question.
No, not at all. No, basic questions are at the heart of things. Yes, it's a very interesting topic, isn't it? And so look, on the buyback thing, yes, I mean, you're right. So another way of playing this is for us to do bigger buybacks and lengthen them out. And frankly, we wish we had done that last year. And so, yeah, and we didn't. And there's there's an embedded assumption, which is worth questioning, that if we do smaller buybacks, there'll be less of a less impact on the stock, and therefore we'll be able to buy in the stock at better levels for our shareholders. But we do know the way that against missed opportunities. Last year was the first time ever where we just had so many things going on that got into the way. It was our first and very painful experience with we wish we had done a longer term buyback and bigger size. So we are monitoring the situation, but yes, your thinking is clear and is certainly a possible alternative and one that we will try to be thoughtful about. It is. There's one other thought. The idea of not using a trust bank is kind of off the table. So lengthening out the term of your buybacks is doable. Kind of trying to do it by ourselves in the market is not. You will have to hand this over to a third party in order to avoid the problem being tainted by an MPI. But your essential point, which is you can lengthen the buyback, yeah, absolutely. And it's something we may end up doing. For the moment, we've decided to do a smaller, shorter term one. Did I get your second question?
Yep. Thank you very much for your time again.
No, thank you. We next have a question, looks for our input from Clive. Clive, can you unmute yourself?
Hi, can you hear me?
Yep. Thanks so much for joining.
Hi, Scott. Good to speak to you again after a while. So I had a couple of questions actually. One was regarding the REITs, and you alluded to the fact that they're not growing, and in particular the green REIT. So I wonder if you could maybe kind of tell us about what your kind of thinking is on how you kind of get that going again, because you said you'd like to grow those, obviously. What can you do to kind of make that happen? Especially in the green REIT, given it sort of seems strange. It seems anomalous in the world we live in today that with renewables and renewed interest, growing interest in that you don't have a green REIT that's growing. Yeah.
Well, I mean, that may be our fault. So look, and kind of across the board, when I say all right, it's probably my fault. So look, can I give you some history on all of these, the two REITs, and technically speaking, the green is an infrastructure fund, so it's REIT-like without being a REIT, but yeah, we can call it a REIT also. Classically, sponsors have kind of abused trust. They haven't dealt fairly with shareholders. They've used these as vehicles to put in assets, not necessarily at a correct price. And we just think it's wrong. I mean, we're fiduciaries. We work for all of you, and we work for all shareholders. And so, it's been very important to us that any transactions that the REITs do will be good for the REITs. And so, for me, that meant for a long time, I was against doing any transaction on the REIT. For example, look, to grow the REITs, they have to pay out all the dividends. So you really don't have the ability to grow unless you do a public offering. And so, I felt very strongly we shouldn't do public offerings unless they were manifestly accretive. thought, now remember, I mean, of course, shareholder value, so a share price is effectively is EPS times the multiple. And the thinking was, if we are relentlessly focused, great fiduciaries, we're going to get a high multiple. And so not only will we do a better job of growing EPS for our shareholders of the REITs, we also get a high multiple for that. If we get a high multiple, then we're able to do, it's easier for us to do accretive transactions. Clive, that's not what happened. And it didn't happen for years. And so I was like, basically kind of a value investor at heart. The market's going to get this right at some point. But it's become pretty clear the market is not giving us a high multiple. They're actually been punishing us for not growing our size. And so the irony is choosing not to do public offerings has been punitive for shareholder value at the REIT level. So we're just rethinking it. And so we haven't done POs for years. We're certainly not going to do something kind of super like wildly kind of massively dilutive, but it's creating, we're going to experiment a little bit. Okay, maybe we should come to market. And so that's kind of the obvious place to start, to see if we can do public offerings that win market support and create a virtuous cycle, which is, to me, it's ironic. I mean, other REITs have been doing dilutive offerings, but they've earned a multiple because, quote unquote, they're growing. Where growing is not growing EPS or DPS, but growing kind of asset size. Japan is a little bit of a too big to fail thing. Big is good. Banks like it. I understand all that. So anyway, that's one thought. On Ichigo Green itself, this is kind of trapped between two legs of a stool. I don't know. I left the United States of America in 1994. I may not remember my English, or if I do have English, it's like from the 1980s. It's and Will is good about reminding me on a regular basis, that there's an opportunity here. We have all these assets, great assets in our clean energy business. Green is priced kind of too low for us to want to put those assets into that business, meaning these need to be transactions that are good for all shareholders. And yet green is also not necessarily priced high enough in order to buy assets from other people. So it's kind of stuck at, it's not growing. And to be honest, if the big places to really move the needle and have an impact and to kind of break through is not going to be at office. It's green. It's going to be at office because it's so much bigger. It's a 200 billion yen portfolio. And hotel, probably has more of an opportunity given its kind of sophistication and ability to add value to assets, including be prepared to kind of grow quickly. So I wouldn't hold your breath on growing, but it's run really hard. It's run super low cost. It's a great vehicle. It's hard for institutions to buy. It's largely at this point an individual investor portfolio. Do we have hopes and dreams for it? Yes, but it's not clear. I hope it's okay to be super transparent that that's going to be the major vehicle for growth. I would expect to see a lot more out of office and hotel. Did I answer your question?
Yes, perfectly. Thanks very much. And then I had a second question.
Sure.
On the mid-sized office market, looking at the short terms, we can see, just in the office market generally in Tokyo, occupancies and rents have been kind of edging down. Yeah. And it is what it is, from very high levels, obviously. But what's your view on sort of the medium to longer term on where the mid-sized office market goes in Tokyo? I mean, it's easy for people like me to get a view on the big, the mega-sized office market and know what's going on with new mega projects in Toronto and places like that. But what's going on in the sort of the less visible and dare I say glamorous end of the market where you guys are playing? What's the sort of medium term, long term outlook for that? If you could talk through that, please.
Can I say it's a better asset class? It truly is.
Okay.
Everyone gets focused on kind of the big buildings because they're exciting and they're beautiful and they're trophy assets, and they have this like huge volatility, and they come with kind of premium pricing, and frankly, it's harder with a big asset just as physics and engineering to make it earthquake protective, and you have all these tenants, and and typically bigger tenants with more pricing power And so it's an inferior asset class. And so, you know, the great thing about mid and small office is how incredibly robust and how diversified and how durable the economics are to the asset class. And so, to your point on rents, we have actually experienced no downtick in NOI in our offices. Outside of a little bit of COVID, because typically, you know, so we do very well located, you know, central CBD kind of office near the station, and typically, as you would know, Clive, the first floor is going to be retail.
Right.
So, you know, we've had some turnover in retail tenants from that, but you release at a higher rent because, as you also know, Japan has quasi rent control, and so we've had such a good kind of rent market, I mean, economic and operating environment for like a decade, that people are kind of in place rents are typically kind of 20 to 30% below where they should be when you release. So we continue to have, we're long vacancy in our mid-size office portfolio. When tenants leave, we get to have a small celebration, which feels inappropriate because the tenant is leaving, but it means we get to release that typically, as I say, these days, kind of 10 to 20% higher. Over the longer run, that still feels very durable. And the reason is small. So who occupies small mid-sized office? Overwhelmingly, it's small and mid-sized firms, and I'll speak to that. But it's also big firms increasingly because they're doing kind of more satelliting and more downsizing. And so we've got a new source of demand because classically mid and small size office was just a small mid SMEs, and now we have bigger companies coming into the space because they like the kind of better pricing, and they want to have kind of remote work, and they also want to have, you know, offices. So there's a new source of demand for that. But most fundamentally, the big drivers of demand in this business, in this asset class, are SMEs, and they are desperately fighting for talent, and they want to do it with office space. And so we're hearing from all our tenants is, yeah, we're doing more remote. We have less people in the office. That's going to be ongoing, and we want to keep our space. You know, we always thought it would be more attractive to have more space for worker, and this is important to us. And they're also seeking to upgrade and want better quality space, again, in the fight for talent. So, as you know, when you hire somebody in Japan, it's effectively a lifetime commitment under Japanese labor law. You're better off, if you can, trying to keep your talent, not by raising their salaries by 10 to 20 to 30%, but by paying the 10 to 20 to 30% more for better office space that makes them feel that's near that station, and you don't have to put on an umbrella when you walk to the office, all that sort of thing. So office continues to be ironically supported. Everyone thought that the decrease in workers was going to be a demand drag on mid and small size office, but in fact, it's been a demand driver because there's been, for the fight, in the fight for talent, SMEs want to have more space for worker, and that's more than the decrease in the number of workers in terms of its impact. Did I answer your question?
Yes, perfectly. Thanks a lot. I would have a follow-up, but I noticed we're over the hour, so I'll leave it there. Thanks very much.
All right, thank you. Don't mean to cut everybody off. Clive, you're a gentleman. Thank you very much. I think we were done. We actually have run over time. Thank you so much, everybody. Really appreciate your time, and we're going to work hard for you. Everybody have a really good day. Thanks so much. Bye.